The cash flow statement presents a comprehensive picture of the cash inflows and outflow of the company over a specific period of time. It's included cash inflows, cash which represent coming into the business from various sources such as sale, investment, and financing. It's also included cash outflows, which is represent cash leaving the business for expenses, debt repayment, investment, and other purposes. Cash flow statement is prepared for a specific period, such as monthly, quarterly, or yearly basis, and provide snapshot of the company cash flow activity during that time. The objective for the cash flow is to track cash flow, understand the movement of cash into and out of the business, identify the cash flow, analyze trend, identify potential areas of improvement, evaluate the company's ability to meet its short-term financial obligation, and also it support valuable insight for strategic planning, investment decisions, and financial management. The cash flow statement is divided in three main activities: operation activities, which is the main revenue producing activities of the entity that are not investing or financial activities. This is included all the cash that we receive from selling our product, which is the primary reason for creating this company. And the same thing for the cash out, which is included salaries, payment for suppliers, payment for taxes. We have invested activity. This is the acquisition and disposal of long-term asset and other investment that are not considered to be cash equivalent. So this, when the company buy fixed asset, this will be reported as investing activity. Investing activities. The same thing when we sell an investment, this cash in will be reported in the cash flow statement as investing activities. Then we have financing activities. This is the activity that alter the equity capital and borrowing structure of the entity. If the company gets money from the bank, so this is a loan that will be considered as financing activities. When the company starts the repayment for the loan, it will be booked and classified as financing activities. There are two types of cash flow statement. We have the direct method, then we have the indirect method. So the direct method, this is the format for the direct method, which starts by the opening balance, which is the opening balance for the beginning of the period. Then you can see that we have different three main activities: operation activities, investing activities, and financing activities. We have net change in cash. This is the top addition for the three main categories. Then we have the closing cash balance, which is the addition of the opening balance plus the net change in cash. Inside for each activities, you can see that we have cash received from customer, cash paid to suppliers, cash paid for operation expenses, and cash paid for taxes. Then we get the net cash flow from operation activities, which is the difference between cash in and cash out. For the cash flow from investing activities, we have proceed from sales of equipment minus the purchase of equipment, and we get the net cash from investing activities. Lastly, we have financing activities. This included stock movements, loan, repayment of loans, dividend payments, and we get the net cash flow from financing activities. Now let's look to the indirect method. This method is a common approach to prepare for cash flow statement. The big multinational company use this method. It starts with the company's net and make adjustment to reflect cash flow from operation activities. It starts with the net income, which is the starting point for the indirect method. This represents the company's profit for the period, and we get from the income statement. You start to see how different financial statements are related. Now we have adjusting for no cash items. So all the no cash items such as depreciation, amortization, and gain or losses on the sale of asset are added back or subtracted from net income to determine cash flows. Now we have net changes in working capitals account, which included account receivable, inventory, and account payable are considered to determine the cash flow from operation. We have an example for the indirect method. This is the format for the table, including description, the net income. Then we have different adjustment for no cash items, included depreciation for 5,000, amortization for 2,000. Then we have gain on sales of equipment, which is minus 1,000. Then we get the adjusted net income. This is the first calculation, which is calculated by net income plus depreciation, amortization minus the gain on sales of equipment. So those items are not considered as cash out because for depreciation, example of depreciation booked in the income statement, there is no cash out. The cash out was when we purchase the fixed asset. For that reason, we subtract to add this value back. The same thing for amortization, and for the gain on sales, we subtract because there is a gain without any. This is profit for the company, but there is no cash in. So here we get the adjusted net income, 50,000 plus 5,000 plus 2,000 minus 1,000. Here, it is the calculation, add depreciation, add amortization, subtract gain on sales, and we get 56,000. The next step, which is adjustment for changes in working capital. We have an increase in account receivable, an increase in inventory. We get this value from the balance sheet account, an increase for account receivable, an increase for account receivable. That means we are paying, we are purchasing, we are spending money, and we invoice to customers, and we haven't yet received money. Increase inventory, the same thing. That means we purchase inventory, we are paying money, so we decrease our cash. So all the asset account will be subtracted, and for liabilities and equity, it will be added. We have an increase in account payable, so we put plus 1,500. Increase in accrued expenses, we add them to the total, and we get net cash by operation. And we continue the same thing from investing activities and financial activities. Let's see an example for the indirect method. This is our income statement. This is the balance sheet. And here you see that we have net income. We get it from the profit and loss statement. Then we add depreciation, 5,000. We get it from the income statement, or we get it in the note that we receive from finance department. Then we have gain on sales of land. So we need to subtract this amount. Then we move to the change in balance sheet account. There is inventory increase for 2005. So we said before that for the asset account, when there is an increase, we need to subtract it. Prepaid insurance increases, so we subtract this value, 700. Then account receivable decrease. Our account receivable decreased by 4,500, so we added. So minus, we get plus. Then decrease for account payable. Account payable is it liabilities? It is liability account. So that is minus, is decreased by 1,800. So we keep it minus as well. Salary payable increase by 400. You can find it here. And we add it to the total. Then we get the total for all the adjustment for operation for the amount of 100. Then we have net cash used in operational activity is 4,440, which is the addition of net income plus the total adjustment for no cash items and net changing in working capital. Now we have financial activity. We get the value from just a property plant of equipment. We get the value in the same thing in the cash flow statement, 40,000. Because there is an increase, we put it in minus. Proceed from sales of land. This is the information that we get from the finance department in the note that we need to add this value. Then we have cash flow from financial activities. This is different movement in the balance sheet account. Then we have net increase in cash and cash equivalent for 13,800. This is the addition of the three main activities. Then we have cash and cash equivalent at the beginning of the period. And finally, we get the cash and cash equivalent at the end of the period, which is the addition of cash at the beginning plus the changes during the period. Once we complete the both method, so we need to make reconciliation between two methods to make sure the balance are the same, starting from the beginning balance and all the movement to check the closing balance at the end of the period should be the same. Also, the balance that we have in the cash flow statement should be the same as the value that we have in the balance sheet.